Transaction programmability, supported versus not supported. Are transaction-level application programming interfaces, APIs, supported? If so, can they be created in a permissionless manner, only by the CBDC authority, or somewhere in between? Who defines the API? Is there a governance process to determine API requirements? Transaction programmability refers to whether, broadly, third-party developers are able to code rules into a CBDC system, such that those rules are executed when the predefined conditions are met. Point 38. This does not refer to the ability to uniquely identify specific CBDC units and place restrictions on their use. For a discussion of that design choice, refer to the fungibility design choice. Transaction programmability can be supported, such that the CBDC system has smart contract programming capabilities that developers can use to develop programs to run on the CBDC system. Alternatively, transaction programmability could not be supported, so that most or all CBDC cannot be programmed to function in more specific ways. Hybrid options are also possible. For example, programmability could be supported for broad use cases, e.g., regulatory and monetary policy, and execution of some smart contracts could be extended to intermediaries, but direct programming against a ledger could be unsupported. Programmability could also be allowed for applications that use data from the CBDC system without having direct access to CBDC system infrastructure. Trustworthy programmability is highly entangled with the cryptographic primitives that are chosen to enable security and trust. Because programmability can also have trade-offs with privacy, the design choices about identity privacy and transaction privacy are also closely linked to programmability. The data model chosen is relevant here. For example, an unspent transaction outputs (UTXO) model, as described below, may make it harder to conduct auctions using smart contracts. Point 39. Finally, questions of governance are also important here. If transaction programmability is supported on a centralized system, it will likely be important to ensure that the central authority or authorities are verifiably committed to following and executing the rules. Design choice benefits and drawbacks are described below. Transaction programmability supported likely supports payments innovation, allowing entities or developers to build in their own programs could enable new forms of payment technologies, similar to the ecosystem of innovation seen with smart contracts. This may not be fully realized if programmability is only partly supported, e.g., if the CBDC system is deployed with programmed rules established, but does not support third parties to build in their own programs. May harm the privacy of sensitive financial data. Programmability is often based on verifying that a certain set of conditions is true, which then initiates the execution of the smart contract. In order to verify that set of conditions, the smart contract needs access to 38. Transaction programmability is often implemented through transaction-level APIs. 39. Allen, S. Kapkin, S. L. Vicente, G. Ford, B.A. The Grimmelman, J. and Zhang, F. August 2020. Design choices for central bank digital currency, policy and technical considerations, No. W27634. National Bureau of Economic Research, 51-2. Technical evaluation for a U.S. CBDC system. 25. Certain sets of data. This can lead to privacy risks to sensitive financial data, although various privacy-enhancing approaches, e.g., ZKPs, could help mitigate these risks. May make the CBDC system less secure. In the private sector use of smart contracts, there have been a number of bugs, mistakes, and hacks that have caused smart contracts to behave in unexpected or malicious ways. While this can be partly mitigated via controlled libraries for smart contract programming languages, upgradable code, and code verification, there will likely still remain key security risks with programmable CBDC. May worsen systemic risk. A network of smart contracts, and the potentially high interdependency between them, could create unexpected feedback loops, where the whole system triggering rules in parallel could collectively create systemic issues for the financial system. May reduce financial protections for consumers. Programmability might introduce challenges for stopping code execution in response to bankruptcy, recovery and resolution, or other court-prescribed activities. The smart code execution is driven by standard external inputs and may have additional challenges for adjusting or accommodating extraordinary events such as bankruptcy or receivership, which could lead to violations of laws or regulations. Transaction programmability not supported. The benefits and drawbacks of not implementing transaction programmability are the inverse of implementing it. Data model, unspent transaction outputs versus account balances. What model is used to maintain records, unspent transaction outputs, UTXOs, or account balances? The data model refers to the method of keeping records about ownership of CBDC. The CBDC system could use the UTXO data model, where the transfer of specific CBDC units is tracked, e.g., like coins being transferred between individuals. Alternatively, the CBDC system could use the account balances model, where it tracks the aggregate amounts of CBDC held in different places. The system could also use a hybrid of these approaches. The data model is closely linked to many other design choices, including those involving the transport layer, identity privacy, transaction privacy, and offline capabilities. Design choice benefits and drawbacks are described below. Unspent transaction outputs, UTXOs, may enable more privacy for sensitive financial data. It is a bit easier to do privacy-preserving cryptography with this model. Individual UTXOs can be linked to unique keys, so that they are not all easily tied back to one individual's account. Meanwhile, with the account balances model, many people will likely use one account for their 26 technical evaluation for a US CBDC system. Transactions, which means all transactions could be linked back to a single person more easily. Likely easier to expand access for all Americans. As a CBDC system scales, the UTXO data model is likely to make it easier to facilitate more transactions, e.g., transactions can happen in parallel without needing to sequence them to avoid double spending. With the account balances model, transactions require editing a global state about account balances, and these edits likely have to happen sequentially so that money isn't double spent. This might provide a challenge to scaling the CBDC system. Account balances may support certain types of payments innovation. The account balances model could make it easier to reference outside states via oracles or smart contracts. Global account states would make it easier to incorporate transaction programmability. It is harder for a UTXO data model to reference the full global state of the CBDC system, which is likely a key feature for achieving extensive programmability, e.g., enabling the checking of other users' balances. There is also a spectrum of designs between the UTXO and account balances data models. For example, some projects have used a hybrid approach that features a collection of object states as its data model. Ledger history, none versus centralized versus distributed. Does the CBDC maintain a history of issuances and transactions, and what information is stored, e.g., value, issuer, and for how long? If a decentralized system is used, do nodes contain all or part of the transaction history, e.g., full versus light nodes, or partition the storage workload, e.g., sharding 40? Ledger history refers to the maintenance of a history of issuances and transactions in a CBDC system. A CBDC system could not store ledger history. For example, a system of smart cards, e.g., mobile phone SIM cards, may not need a ledger. A CBDC system could store ledger history on a more centralized ledger, with the central bank providing the core infrastructure and with trusted intermediaries operating key features, e.g., adding transactions to the ledger. Alternatively, a CBDC system could store ledger history in a more decentralized manner, with trusted intermediaries or individuals being able to operate their own nodes to facilitate part of the CBDC system. The specific questions about which information is recorded are addressed in previous sections on identity privacy, transaction privacy, remediation, and data. The choices made in those sections are highly relevant here, because different pieces of historical data could be accessed together. The risks to privacy and AML/CFT controls would be shaped by the specific pieces of information being stored. Additionally, remediation will likely be more challenging if a distributed ledger is chosen such that no trusted entities have unilateral right access to the ledger. 40 sharding refers to taking natural subsets of data in a database, often to help improve performance. See, e.g., Amiri, M.J. Agrawal, D. and El Abadi, A. July 2019. On sharding permissioned blockchains. 2019 IEEE International Conference on Blockchain, 282-5. Technical Evaluation for a US CBDC System 27. Design choice benefits and drawbacks are described below. None may improve security and privacy of sensitive financial data, a key way to protect privacy and security is to not capture information. Point 41 By not maintaining a ledger, there would be fewer places where sensitive financial data could be accessed. May introduce risks for consumers, investors, and businesses. It may be impossible to offer all the features and requirements of a central bank asset without any ledger. A lack of a ledger, even one that only temporarily records transactions, could make it harder to resolve critical failures and conduct remediation. May have implications for expanding equitable access to the financial system. A lack of any historical ledger directly tied into the core CBDC system could foster widespread distrust in the CBDC system, especially during its early adoption phase when there may be doubts as to whether the system works properly. Alternatively, because privacy concerns are one of the most cited reasons for not having a bank account among unbanked households, 42 The lack of a ledger may help increase adoption of a CBDC among the unbanked and underbanked. Centralized ledger. Likely more functional and efficient, a centralized ledger would likely be easier to build and operate, especially at the scale needed for a US CBDC system. May have implications for payments innovation and consumer protection, since a centralized ledger approach is similar to how electronic money transactions are currently tracked. This approach is more familiar and better tested. However, this familiarity may limit full consideration given to incorporating the latest features in areas like encryption and programmability, possibly limiting innovation, but also possibly better protecting consumers, investors, and businesses. Distributed ledger may be less functional and efficient. Further research would have to be performed to understand if distributed ledgers can support transaction rates and latency likely required by a US CBDC system. This could build on the considerable energy that has been invested into research on additional technologies to enhance underlying distributed ledgers to provide them with the ability to transact, e.g., something similar to a Layer 2 technology 43. Additionally, many of distributed ledger technology's features, immutability, cryptography, programmability, and smart contracts, can also be realized through a centralized ledger approach, if desired. 41C, e.g., Fanti, G, Kostianen, K, Howlett, W, Lipsky, J, Moore, O, Schnapper-Casteres, J, and Wolf, J, June 2022. Missing key, the challenge of cybersecurity and central bank digital currency. The Atlantic Council. CBDCs with stronger privacy rules may generate and store less sensitive data in the first place. In turn, potential attackers have a smaller incentive to infiltrate the system. 42 How America Banks, Household Use of Banking and Financial Services, 2019 FDIC Survey. October 2020. Federal Deposit Insurance Corporation. 43C, e.g., Martinazzi, S., and Flory, A., 2020. The evolving topology of the Lightning Network, centralization, efficiency, robustness, synchronization, and anonymity. PLOS 1, 15, 1, E0225966. 28 Technical Evaluation for a US CBDC System. May harm security and consumer protection. When coupled with permissionless governance, distributed ledgers create new potential ways of attacking the system, e.g., 51% attacks. Some of the additional functionality that such systems have enabled in private sector administered digital assets, e.g., transaction programmability, has been a prime target for attacks. May promote payments innovation. Incorporating a technology with significant industry research and development could have downstream effects on innovation in the CBDC system and the government as a whole. For example, assuming that distributed ledger technology has some role within the ecosystem of CBDC ledgers, it may enable increased innovation in programmable money and smart contracts. May not be sustainable. Some types of consensus mechanisms used to maintain synchronicity between distributed ledgers raise environmental concerns. If one of these consensus mechanisms were used in a CBDC system with a distributed ledger, this design choice may not align with the policy objective that a CBDC system should be sustainable. The length of historical storage is also an important question. Ledger history would likely be required to be recorded for long enough to facilitate AML/CFT compliance and to ensure that offline transactions can be verified against the history of previous transactions. However, data would likely not be required to be stored indefinitely in order to enable any core parts of a CBDC system's functionality. For security and privacy purposes, it would make sense to store ledger history for as little time as required to fulfill policy objectives. Adjustments. A CBDC system could facilitate a number of financial design choices, such as special-purpose CBDC, holding limits, fees, and interest whose merit is outside the scope of this report. Point 44 This section focuses on analyzing the associated technical design choices that would enable those financial design choices. Fungibility, fungible versus non-fungible units. Can the CBDC system support non-fungible units? A non-fungible unit is a discrete unit of CBDC that has a unique identifier, e.g., a serial code. For example, even though physical dollar bills are often considered fungible, under this definition, a physical dollar bill is a non-fungible object. Each physical dollar bill is a unique physical object that has a serial number, and can be held, destroyed, or exchanged for another unique physical dollar. A CBDC system could support fungible units that are not unique, and thus function identically to each other. A CBDC system could also support non-fungible units, and thus can enable different. 44 For further consideration of some of these design choices, see the Future of Money and Payments. September 2022. Department of the Treasury. Technical Evaluation for a US CBDC System 29. Processes for their use. Point 45 A CBDC system could also use both approaches. In a corollary to cash as a unit of payment, cash can be serialized. If something is wrong, a participant can take it out of circulation and reprint that note with the same serial number with an annotation of reprint. Fungibility will likely overlap with choices made about storage and the transaction model. Fungibility could also impact how CBDC is packaged for offline transactions, and how the CBDC system interoperates with other payment systems. Design choice benefits and drawbacks are described below. Fungible units may promote privacy of sensitive financial data. Fungible units are not marked to be uniquely traceable down to specific CBDC units, potentially increasing the privacy afforded by the CBDC system. This could advance the policy objective of aligning with democratic values. May promote increased interoperability. Fungible units could be subdivided and exchanged with each other, as the uniqueness of any specific CBDC unit would not need to be preserved. This could advance the policy objective of ensuring the CBDC system should be appropriately interoperable. Non-fungible units. Likely helpful for economic activity, non-fungible units could enable the limiting of certain CBDC to be used toward more economically beneficial uses, especially during times of recession. This could be a helpful tool for regulatory and monetary policy. May promote national security, possibly at the risk of human rights and aligning with democratic values. Specific CBDC units could be marked as tainted if they are used in illicit activity. Regulated entities could be prohibited from engaging with this tainted CBDC, which would reduce the market value of those CBDC units, thus making it less profitable to use the CBDC system for illicit activity. This could advance the policy objective of national security, although misuse of this power, e.g., to target political adversaries, could be counter to the policy objectives of protecting human rights and aligning with democratic values. 46. Could affect human rights and democratic values, because non-fungible CBDC could enable some CBDC units to be treated differently than other CBDC units. This design choice could be used to restrict how individuals use CBDC. For example, some CBDC could only be able to be spent on travel or, in a more sinister example, could be limited to disallow certain lawful transactions, such as not allowing spending for religious causes. This may also limit adoption of the CBDC, which could be counter to the objectives of improving payment systems and U.S. leadership in the global financial system. On the other hand, programmability could also be used to prevent currency from being used in various ways that harm consumers or violate human rights. 45. There are further technical specifications that could limit the actors that could treat different units of CBDC differently from each other. For example, CBDC could be serialized with numbers that are encrypted, such that only certain intermediaries are able to decrypt those numbers. 46. This is not the only way to control usage of CBDC. Assets or accounts might be restricted from using CBDC in other ways, based on other design choices made for the CBDC system. 30. Technical evaluation for a U.S. CBDC system. It is also possible to operate a hybrid version, where some units are fungible and some units are non-fungible. For example, standard CBDC could be fungible while there could be some CBDC that is non-fungible, e.g., benefit disbursements for the Supplemental Nutrition Assistance Program, which could be non-fungible so it could be limited to being spent on SNAP-eligible purchases. Holding limits, limits or no limits. Are there limits on how much CBDC any particular entity can hold? Holding limits refer to limits on how much CBDC any particular person or entity can hold. The CBDC system could impose limits on how much any particular entity can hold in CBDC. Alternatively, the CBDC system could not have such limits. The CBDC system could likely enable this functionality if there are mechanisms, such as consumer due diligence, requirements, or costs, to prevent entities from creating multiple accounts. This design choice is closely related to identity privacy, for the reason mentioned above. This design choice may also be linked to access tiering, as it is possible that holding limits could be imposed for some tiers and not for others. Design choice benefits and drawbacks are described below. Limits may help mitigate risks for consumers, investors, and businesses. Limits would cap the damage that consumers, investors, and businesses might incur via the CBDC system. May introduce risks for keeping sensitive financial data private. Limits might be implemented in a way that requires intermediaries monitoring the balance of individual accounts, or by linking balances across accounts together. These approaches might harm privacy. However, more privacy-preserving approaches are possible. For example, ZKPs and secure hardware-based approaches could prevent transactions, including P2P ones, from completing if the recipient's balance would exceed a certain threshold. No limits may limit benefits to economic activity. No limits may be a benefit for businesses that hold or exchange large volumes of CBDC at a time. This might make it easier to use the CBDC system for economic activity. Though economic considerations are out of scope for this report, it is worth noting that there are important economic considerations here. For example, if a substantial portion of deposits are held in the CBDC system, this might reduce loan creation by financial intermediaries due to lower deposit volumes. Additionally, without appropriate safeguards, this could increase the likelihood, severity, and speed of bank runs, as a CBDC system could allow users to quickly withdraw deposits from a bank if they believe it might fail, even with the existence of deposit insurance. 47, 48. 47. A recent paper finds that bank runs can be more frequent with a CBDC system. Williamson, S.D., 2021. Central Bank Digital Currency and Flight to Safety. Journal of Economic Dynamics and Control, 104146. 48. The European Central Bank simulated systemic runs on banks based on the recent experience by Greece and Cyprus. They found that no limit accounts can allow for faster and larger withdrawals. Adalid, R. Alvarez Blasquez. Technical evaluation for a U.S. CBDC system 31. Adjustments on transactions, fees versus no fees. Can the CBDC system support fees? Adjustments on transactions refer to the costs imposed by the Federal Reserve, intermediaries, or other third parties for the use of the CBDC system. The Federal Reserve or the appropriate entity could administer fees for using the CBDC system, or fees could be allowed to be charged by intermediaries as part of transactions in an intermediated system. Alternatively, the system could be built without the concept of fees, and any such charges could be managed as separate transactions. This design choice intersects with many other design choices. For example, the transport layer likely matters a lot. If intermediaries are involved, then fees might be levied on intermediaries rather than consumers directly. In a less intermediated system, fees may help solve efficiency and cybersecurity concerns that might otherwise be handled by intermediaries. Fees may also intersect with access tiering, where lower tiers may not involve fees, while higher tiers could involve fees. Design choice benefits and drawbacks are described below. Fees may improve efficiency. Fees can help the CBDC system prioritize transactions. This is likely less of a concern in an intermediated system where intermediaries can institute their own processes to prioritize transactions. May improve security. Fees can also provide a disincentive for CBDC system users to spam the network with a large number of transactions. This is likely less of a concern in an intermediated system where intermediaries can institute their own processes to prevent spamming. May improve functionality. Fees can help recuperate some of the costs of operating the CBDC system. This would help the CBDC system function efficiently relative to the costs to operate. This may also be a requirement based on existing law and regulation. No fees may help improve efficiency and extensibility. Fees add complexity to a CBDC system. The lack of fees would allow for a more straightforward CBDC system, which may be more efficient and extensible. May not help improve payment systems. Fees would create an additional barrier to the use of the CBDC system, which may prevent all Americans from using the CBDC system. Even if fees were assessed on intermediaries, some of those costs would likely be passed on to consumers. If fees are assessed, there would also be choices about how they are administered, e.g., a percentage of each transaction, a fixed fee to access the CBDC system for a certain period of time. Adalid, R. Alvarez Blasquez, A. Asenmacher, K. Bullen, L. Dimu, M. Lopez-Quiles, C. and Vegazi, Evi, 2022. Central Bank Digital Currency and Bank Intermediation. ECB Occasional Paper, 2022/293, 36-41. 32. Technical Evaluation for a U.S. CBDC System. Adjustments on balances, adjustable versus not adjustable. Can the CBDC system support CBDC that is interest-bearing? Adjustments on balances refers to whether account balances can be adjusted to facilitate features such as interest-bearing CBDCs or fees based on accounts. Accounts could be adjustable outside of fund transfers or not. These adjustments could be made by the central bank, intermediaries, or other third parties. Alternatively, such adjustments could not be built into the CBDC system and accomplished through transfers instead. Either way, the CBDC system could likely enable this functionality, should it make sense from a monetary perspective. This design choice intersects with the transport layer, as an intermediated system would provide more technological methods for creating an interest-bearing CBDC. This design choice also intersects with offline capabilities. If the interest rate is varied over time, it may be challenging, but may be technically possible, to provide interest on wallets that are not able to receive information about the updated interest rate. Design choice benefits and drawbacks are described below. Adjustable balance. Increases technical and governance complexity. A way to change balances outside of ordinary transfers will increase the technical complexity of the system and will add to the governance complexity as deciding who can make those decisions and when will be important. Implementation would be harder and overhead of system design would likely be much higher. May have implications for financial inclusion and equity, if adjustments require connectivity and are mostly positive. Such adjustments may make offline functionality less desirable. On the other hand, an interest-bearing CBDC may provide a more accessible option for consumers to retain value for their CBDC and may help enable more options for monetary policy. May reduce trust, depending on governance decisions. A direct monetary policy lever controlled by the central bank on accounts may reduce public trust in the CBDC system, particularly if negative changes are considered. May help improve payment systems, and interest-bearing incentive to hold may help bring more capital into storage in the CBDC system. This would help increase uptake of the CBDC system, which could help improve payment systems. However, this may also come at the expense of reducing deposits, which could exacerbate risks to loan creation and bank runs. Not adjustable balance. The benefits and drawbacks of not implementing adjustable balances are the inverse of implementing it. Technical evaluation for a US CBDC system 33.